Hi, my name is Jens Peter. I'm a chief advisor at the Danish Embassy here in Nairobi on governance and development finance impact. I have a deep passion for development in Africa and above all, investment in Africa.
And Jens Peter, thank you for coming and sharing your experience. One thing I would like to hear is, so economic development in sub-Saharan Africa is lagging behind Asia and Latin America. Are there any explanations for that in your view?
I think there are, even if I think we're in some ways much better place and certainly a much more interesting place than now than 5, 10, 15, 20 years ago, certainly much more than 20 and 30 years ago. But there are also still some very big constraints and challenges that is facing Africa and anyone that's interested in investment in Africa. For me, I think, let's start with the positives. I think Africa's come a long way. I grew up here 40 years ago, I should say, and I've worked in 7 or 8 countries across East and West and Southern Africa. So issues around identity, Africans feeling that they're actually an equal and important part of the world, issues around racism, to take a very negative one, and even colonialism, which certainly when I started my career 30 years ago mattered a lot, and the legacies thereof. It's still sometimes referenced, but I think by far the majority of Africans are born way after independence, and they see themselves as Kenyans, Nigerians, Ghanaians, Malawians, rather than anything else, and they are confidently happy with that. There are still populist tendencies, like in any other country, that sometimes try to use those historical legacies as explanations for non-progress or barriers to progress, and undoubtedly there are global structures that are maybe not in Africa's favor. That's kind of the backdrop to what I'm going to say now in terms of the more specific challenges. Coming to that, I think probably 3 or 4 highlights, if you wish. I still think economic structures and regulatory capacities are low. Workforce capability, infrastructure, quality of investments. But actually, rather than talking about those, which we can go into as much detail as you or Michael would like, there's lots of evidence around, I'd rather say the institutional capacity, uncertainty. If I'm an investor even in Kenya or Ghana, which are probably 2 of the better places, I don't know. I mean, the risks are much higher, political risk, the regulatory quality, and even it's not about under-regulation, it's also about overlapping regulation. So those are probably some of the things I hear mostly from investors, and when I do my own analyses, that keeps investment back. Political, regulatory quality, and then basic infrastructure as well. Cost of doing business is much, much higher. Cost of moving a truck from Mombasa to Nairobi, to take that, or from Tema port in Ghana to the Ivorian or Burkina Faso border, costs more than getting the same container from Hong Kong to that port. So those are some of the top structures that I would highlight.
Yes. What would you say are the key considerations you should have as a foreign direct investor in, for instance, Kenya or another sub-Saharan African country?
Yeah, another absolutely key question. I think, again, 3 or 4 points. One, I think your time horizon, you have to accept that you need local knowledge, and it's important not to see Africa as a country. So local expertise, either within your own company or in-source it, is definitely one to understand how to maneuver. I think your time horizon, the days, if they were ever there, where you could enter Africa, make your million or your bucks, and then leave 2 or 3 years later, are gone or were never there. I think we're talking 5, 10, 15-year horizons for most investors and most sectors, and I think that's a good thing. I do think prospects to make money in Africa over the medium and long term are very high if you know what you're doing and you have the right product. But the time horizon is really, really important. Managing risks would be a very, very high one, and I think I'm saying that because the risks are, I think, arguably different from most other places, certainly different to Asia and Europe and the US. Political risks are probably higher, or they are higher, I would say, even if when I watched yesterday the Eurasia Group's top 10 risk for 2020, there was no mention of Africa or any African risk factors. But when I say political risk, elections are much more disruptive here than anywhere else. The risks of capture by a politician or political dimensions is higher and something you need to be much more aware of. In most cases, they can be managed. Of course, if you have a product that's very time sensitive and sensitive to stuff that elections can disrupt, you need to be aware of that. Wider political risks that goes under political capture. Of course, it's important to have a network. I would say deals based with politicians are really good investments and more for, sorry to say so, wheeler dealers. So I'm not speaking to that audience, frankly. I think for normal sound investors, it's important to manage the politics, as I said, and know how to work around it and understand the impact on the regulation that affects you. If you're a big investor, I would engage a lot with lobby organizations that work with the regulatory frameworks. So that's a second layer. My third layer would be, on balance, in most cases, you would have to engage more with the communities and in some cases the public than you would otherwise. Even if you're fully compliant in terms of regulation, the risks of misunderstandings with local communities are higher. Again, especially if you're a public-facing or private sector, consumer-based company, so that would have to be based more. Wider risks, understand that, and goes under regulatory, but I want to highlight it. Infrastructure is worse. Uncertainties, let's say, if you're importing stuff through a port for your supply chains, but also for exports, of course, are higher, so you need to understand those much, much better. The upside is you have a market that's growing even in a bad year by 3% and in most cases by 4 or 5%, and that is seemingly generic, so you can expect those growth rates for the duration of your investment and beyond.
Based a little bit on that, how do you see that you could practically use scenario analysis to work with these risks?
I think that's a really important dimension and something that I use a lot, both for my day-to-day work on kind of core governance, but also vis-a-vis planning off work and country business plans, if you wish. I do think is that this area has major potential. It's important not just to have a high, medium, low risk set of scenarios, but really drill down and find what are the 4 or 5 most likely scenarios. If that covers 80 or 90% of the scenarios, and you then within each scenario, and especially the kind of lower ends of the risk scenarios, the positive ones are normally self-managed, but to understand what are the real risks and how can we mitigate those, and especially in the kind of low scenarios, let's say an election where for whatever reason you are either sensitive to 3 or 4 months of disruption or low demand or affecting your supply chains, how can you prepare for that either pre-event or during event, or in the kind of worst case scenarios, how early could you see that worst case scenario is about to play out so you can cut your losses early on to take this super negative scenario. But I do think thinking through the top 1, 2, 3 dimensions of each scenario will help massively in your risk scenarios. Frankly, also in the positive, I've come across investors that have not been sufficiently prepared for success. If your demand goes up rapidly early on in a context where supply chains are slow and not as adaptable and fast and flexible as they would be, let's say, within the EU, you need to be prepared for that as well.
So many would say that China has made a significant entry into Africa, for instance. How do you see that? What's your take on this new development?
Yeah, I mean, this is definitely work in progress, and you're absolutely right. China is a massive player and a rapidly increasing player in a number of African countries. Undoubtedly, there have been positives. I mean, they're maybe less so in the direct private sector, apart from infrastructure. You know, as a player in public sector infrastructure, they have provided finance and production, if you wish, of major roads and infrastructure, less so ports, but rail and roads are the two big ones, faster than anyone else could, and that has, on balance, been a good thing. I must say I'm slightly more skeptical, as are many others, towards some of the bigger investment and political investments, let's say in DRC and possibly here in Kenya, on more rails than roads, where there's probably some evidence that they are, they are inefficient. As in, if you have a railway that's cost almost $4 billion, as is in the case in Kenya, and there are 2 trains moving up and down per day,